So for those that don't know and aren't Champion clients, Champion is an accountancy, tax and business advisory firm working with businesses, charities and owner-managed companies across a wide range of sectors. We're running this webinar because the lease accounting changes coming into FRS 102 are likely to affect a large number of organisations, particularly those with property leases, vehicles, equipment leases or service contracts that contain lease elements. I'm Paul Bell. I'm a client director at Champion, and joining me today is Liam Thompson. He's one of our accounts and audit seniors. Between us, we work closely with businesses and charities on financial reporting, compliance and practical accounting issues. Over the last year, we've been helping clients understand what these lease changes mean in practice and how they can prepare for them. The purpose of today's session isn't to turn everyone into a lease accounting specialists, but we want to give a practical understanding of what's changing, who is affected, where the common problem areas are, and what actions you should be taking now to avoid last-minute scramble when the rules come into force for you. So with that, let's look at what is actually going to change. So the biggest headline is that operating leases are moving onto the balance sheet. Under the current FRS rules, leases are split between finance leases and operating leases. Finance leases, which are things like hire purchase agreements, are already recognised on the balance sheet, and it's likely there'll be an asset on there too, which you'll be paying off. But operating leases, think things like rents, photocopier rents and things like that, they're generally charged to the profit and loss account over the term of the lease, with very limited balance sheet impact, if any. The revised model removes that distinction for most lessees. Instead, businesses will generally recognise a right of use asset, representing the right to use the leased asset, and a lease liability, representing the obligation to make future lease payments. These changes apply to accounting periods beginning on or after the 1st January 2026. So businesses need to start thinking about the impact now. And it's likely for most businesses, it applies from the 1st of April. You know, lots of businesses have 31st of March year ends. The rules apply to organisations reporting under FRS 102, including small companies using Section 1A. Lessor accounting, so if you lease the asset to somebody, that's unchanged. You do that as you've always done that. If you're reporting under FRS 105 as a micro entity, then these changes don't apply to you. As we move through the session, you'll see there's a number of stages involved in applying the new rules, from identifying the lease through to measuring the liabilities and understanding the impact on your accounts. With that, I'll pass you over to Liam.
I had a bit of trouble getting my camera on then. Thanks, Paul. So let's get started with a few questions in terms of identifying an actual lease. First of all, does the contract give you control of a specific asset? Typically, examples of these assets are likely to be property, vehicles, plant and machinery, or even high-value office equipment. Secondly, does the business receive substantially all the economic benefits from that asset? And are you able to direct how and for what purpose the asset's used? If the answer to all of the above questions is yes, then it's highly likely that the contract contains a lease. One caveat is substitution. If a supplier can freely swap the asset out whenever they want, then it may not meet the criteria to be classified as a lease. When taking your time to review the contracts, when you're looking at all your leases for transition periods, don't get too caught up in what it calls itself. It might call itself a service agreement, but sometimes it doesn't automatically mean it's a service agreement. It can contain lease elements to it. So practical message for identifying a lease is simple. If a contract gives you control of a specific asset and the supplier cannot freely substitute that asset, it is likely to contain a lease. Just going to move on to determining the lease term now. So To determine the actual length of the lease term, how long? So it's not always the same term as written on the top of the agreement. So obviously you will have seen plenty of lease agreements. They'll have your headline terms on. Don't take that as gospel as that's your lease term. You need to start with the periods where the business cannot walk away from the lease. So you need to assess the break clause and extension options. If the business can extend the lease, ask whether it is reasonably certain to do so. Also, if the business can break the lease, ask whether it is reasonably certain not to break the lease. If the company does have a break option, but is reasonably certain not to use it, then the lease term should usually run to the later contractual end date, typically the headline term of the agreement. Likewise, if the company is reasonably certain it will extend, then the lease term should include that extension period. Just for order purposes, though, it can't just be a feeling. The business needs to be able to support the judgment with the evidence, such as plans for the site, cost of moving, how important the asset is, and what has happened in practice before. A key point on break clauses and extensions is control of the break clause and extension. If the supplier controls the right to extend or break, that's not the company's choice. You should always assess whether the company is likely to do some. You should not assess whether the company is likely to do something it cannot control. Also, rent-free periods need to be included within the lease term. They are part of the lease term, even though there's no cash being paid during that period. We also need to take care with rolling leases. Just because something rolls month to month does not automatically make it a short-term lease. If the business is clearly expected to stay for a longer period, that needs to be considered. This is especially relevant for related party property arrangements in terms of where directors may rent property to the company or other group companies may rent within the group. So in these situations, paperwork may be light, but the accounts still need to reflect what really is really expected to happen. Right. I am going to pass back over to Paul now for the next slide.
Thanks, Liam. So one of the first questions that clients have been asking us is, is there any way I don't need to apply this FRS 102 leases? And the answer is yes, there is. There is a way that you don't need to apply it. The first is, like I said, if you're FRS 105 and you apply that to micro-entity accounts. But if you apply FRS 102 and you have to because of your size, you can still get some exemptions. Not all leases need to go onto the balance sheet. However, for the exemptions, there's only two areas really. One is that it's a short-term lease, and that's, broadly speaking, is less than 12 months and has no purchase option. And then the other is if it's a low-value asset. So let's deal with the first one. You take out a lease, it's 10 months. You can just expense that through the profit and loss account or the SOFA if you're a charity, as you would normally do. Okay. On transition, in the first year, if you've got a lease that was 5 years long and it ends within 6 months or even 11 months, that at that point will be a short-term lease. So you can still expense that through the profit and loss account as you have been doing. However, if it's a property that you're renting and you've got 6 months to a break clause, 6 months to a break clause, but it's reasonably certain that you will extend past the 6 months and therefore past the 12 months, at that point, you have to include that as a right of use asset. So short-term leases are just things with less than 12 months or less on it. The second is an exemption for low-value assets. But this is where a business needs to be careful, because the assessment is based on the value of the asset itself, not on whether the lease payments are low value or material to the business. So things like land and buildings, properties, you rent those, and you might rent them at £2,000 a month, and £2,000 isn't material, isn't a material payment to you. It's only £24,000 a year, but the value of the asset, the property, is probably £500,000 to £1,000,000, so it's that value of the asset that you assess it on, not the value of the payments. And again, this becomes more prevalent in charities where they might get discounted rents, for example, and they might only pay £100 a month as a massively donated asset, and we'll come on to that later. But still, the value of the property is what you assess that on. Okay. So assets such as land and buildings, vehicles, heavy machinery, and significant production equipment are very unlikely to qualify as low value. Examples that may qualify as smaller items are laptops, standalone printers, or office equipment, depending on the circumstances. We see that the kind of printer, scanner, copier, telephone, fax, the big machines that stand in the corner, they are very unlikely, in our opinion, to gain the exemption for a low value asset because they're integral to how a business runs. Okay. So it's important when looking at exemptions not to assume an exemption applies simply because the monthly payments are relatively small. Like we've discussed, you actually look at the value of the asset that you're leasing. And each lease needs to be reviewed on its own facts. So you might have 2 or 3 printer/scanners, photocopiers around, and the lease terms, the lease agreements might be slightly different for each one. So you need to review each one on its own merit and decide whether the exemption exists. What I would say with my auditing hat on, and this comes back to something Liam said, if you are going to make these assumptions and treat them one way, make sure that whatever you've done, whatever assumptions you've made, are well documented, because your accountant, be that whether it's us from Champion or an external accountant, if you're not a Champion client, they will ask for that evidence to see why you've treated it like that and why you didn't believe it should go onto the balance sheet. I'll move on now to embedded leases. So another area that businesses often overlook is an embedded lease. So like Liam said earlier, not every lease is labelled as a lease agreement. Sometimes a contract that appears to be a service contract can actually contain a lease component. So, for example, a contract may provide the use of dedicated equipment or infrastructure that only your business can use. In some cases, that arrangement may meet the definition of a lease, even though the contract itself doesn't use the word lease. We see contracts that combine lease and service elements. So a common example is a vehicle contract that includes maintenance and servicing. Under the standard, FRS 102, the lease element and service element may need to be separated because they are accounted for differently. So generally speaking, the service element continues to be expensed as the service is received, so that will just go through the profit and loss as normal, while the lease element forms part of the lease calculation. Excuse me. There is a practical expedient available which allows businesses, by class of asset, to account for the whole arrangement as a lease rather than separating the components. It might be that you feel that work's going to be too onerous to do that, and if you meet the criteria for the expedient, you can do that. However, what that would do, it creates a higher valued right of use asset on the balance sheet, which may impact your financial reporting and your requirements. So that really, whilst it exists, should be treated with caution. What it may do is, especially for charities, it may increase your gross assets, and that might put you into the audit threshold, even if your income is below the 1.5 million turnover, recognizing these right of use assets and not separating the service element might be the bit that tips you into an audit requirement. So it's worth thinking about that when you're doing these as well. Judgment's often required, and this is one of the areas where you, as a business, you may need professional advice. What I'm going to do is I'm just going to pass you over to Liam, and he's going to discuss a practical example of this and something we've seen recently.
Cheers, Rob. So yeah, with embedded leases being such a subjective area, it's not seen very often. I wanted to just provide a bit of an example. So one of the examples of this is essentially if a supplier provides a business, a lot of you will get hosting services, hosting your servers, and the provider just hosts the data across their wider network. That's just going to be a service. You don't control a specific asset. However, if the contract gives you control of a specific server, that's dedicated to your business and no one else can use that server for the whole contract period, that may be different. This could have the lease element embedded within inside the service contract, and these are the sort of things that you need to look for. The main point for business owners to look past the invoice description. Something billed as IT services, hire maintenance, or facility support could still include these lease elements in there where it gives you access to control a specific asset. Yeah, that's my point on embedded leases and service elements. We're just going to move on, and I'm going to continue. We're going to move on to measuring the lease liability now. So far, we've identified the lease, we've determined the lease term. Next step is we need to measure the lease liability. In simple terms, this means taking the future lease payments and converting them into today's value. A simple way to think about this is inflation. And of course, what better way to measure inflation than Freddos? £10 in 2010 would have bought you around 50 Freddos, whereas today it might only buy around 25 Freddos. I have done my research on that, by the way. We're applying the same broad idea to future lease payments. A payment due in several years' time is not going to be worth the same as the payment due today. So the future payments are discounted back to the day's value. The calculation for measuring the lease liability, it starts with your fixed payments and for any payments that are linked to index or rate increases based on the index or rate at the start, the commencement date. It can also include things like purchase options or termination penalties where they're expected or unavoidable. What you don't include are future payments based on usage or performance. So, for example, if extra rent depends on future turnover, it's not included in the initial lease liability. It's dealt with when it happens and it's accounted for within the profit and loss account. So, off the back of the lease liability, I'm going to move on to the next slide, which is the discount rate we're going to use to measure the lease liability. The discount rate is probably one of the more important areas, but it's also one of the more subjective areas. If the interest rate is obvious from the lease documentation that you've got, then use that. In reality, it's not usually readily available from all the leases I've seen. I don't think I've seen a lease with any readily available interest rates in there. So where it's not obvious, FRS 102 allows the rate to be based on either the incremental borrowing rate or the obtainable borrowing rate, depending on what evidence is available. The incremental borrowing rate is broadly the rate the business would borrow for a similar asset over a similar period. This may be easier to evidence if business already has higher purchase agreements or loans for similar assets in place. The obtainable borrowing rate, which probably is more likely the route a lot of companies will end up going down, is broadly the rate the business could obtain if it borrows a similar amount over a similar period of time. For business owners, the practical point is evidence. Do not just pick the rate because it feels right. Start talking to your bank relationship managers now to see what the rates they can quote you, review any recent loans or HP agreements, and consider whether they are a suitable benchmark. And be careful with old rates. you might have taken a loan out a few years ago that may not be a good benchmark rate. Interest rates have fluctuated massively recently, so they potentially could have moved. So it might be worth still, if you have had a loan from a couple of years ago, going back to the bank and having the conversation with your bank relationship manager. In terms of discount rates, this may be a harder task for charity clients or for businesses that don't have a history of borrowing or buying assets on hire purchase. It is a subjective area, so we can't just give you one figure or one method that works for everyone. So if you are struggling with this, reach out to us. We'll see what we can do to help you work through the evidence. Just going to jump on to the next slide on lease liability, lease payments linked to an index rate. I touched on this before in terms of the lease liability. So a lot of property leases can be linked to CPI or RPI or rent reviews. So potentially your rent will go up every year, but it's dependent on certain circumstances. So at the start of your calculation for the lease liability, you don't forecast future inflation. You don't forecast the future rent reviews. You use the index or rate at the commencement date. Later on, when the rent actually changes, the lease liability may need to be remeasured. And in many cases, that remeasurement also uses the same discount rate. So you don't change the discount rate, even if it's 5-6 years down the line, we're still using the same discount rate. So this adjustment also affects the right of use asset. It's not just a hit to the P&L. So we are putting an addition through to the right of use asset when it is remeasured. The practical point is that leases need to be tracked after the first calculation and recalculated accordingly. Moving on to the next slide. On to Paul.
Yeah, thanks, Liam. So I've noticed that there's a few charities on the webinar today, and it's nice to see you here. So I just wanted to cover some specificities, if that's a word, specifics, that's the right word, for charities. So charities should be aware of situations involving below market value leases or peppercorn rents, where there are additional considerations or donated elements of the arrangement. So below market value lease is one where there's an amount payable, but it's significantly less than the market value. So if you think of some office spaces or a property or something, and they might normally cost £20,000 a year to rent, but you might go and look at them and you might really like them, and the landlord says, you know what, I like your charity and I like what you do. I'll give them you for 10 grand a year instead. Okay. So in this case, you're clearly getting a donated element of £10,000 per year. Okay. And the charity terms this as a social donation lease. What happens in this case, you still perform the calculation based on the £20,000 per year rent. However, the right of use asset would go on the balance sheet at that calculated amount, okay, based on the 20,000. Your lease liability also goes on based on the 20,000. But I know what you're thinking. I'm not paying 20,000 a year, so that lease liability is never going to clear itself. Okay. And that's a fair point to make. But what you do have to do in this situation is the difference between what you will pay for the lease liability, the 10,000 a year, and the 20,000 it would cost and that you've used in your calculation. That bit is a donated element. Okay. Now, what the SORP says is that in year one, so on day one of the lease being signed and being run, that donated element is shown as income in your SOFA. Okay. So it increases your income and it reduces your lease liability. And then over the next 5 years, your lease payments will go against that liability and bring it down to nil. So why is that important for charities? Well, hopefully you can see from what I've said there that if you've got a donated element, and it might be a property, you might rent a property for 25 years. So it may be that donated element is a large amount. And if it's going on to your income in year one as a one-off hit, then it's likely it will take you over the audit threshold, which is 1.5 million for charities, income. So in that year, it's possible that as a charity, you will need an audit under the Charities Act. So that's something you need to keep in mind when doing this calculation. And that's why Liam said earlier, and we'll reiterate this point later, that it's important to do this at the start of the year rather than the end of the year, because you could go through all the year thinking, yeah, we're under that 1.5 million, we're not going to need an audit. Whereas actually, when you do this calculation, you're over that threshold and you do need an audit. And then, you've got to appoint an auditor, you've got to have planning meetings, you've got to have all that kind of stuff that goes around an audit as well, which if you'd have planned for it earlier and done this exercise earlier, you'd have known that throughout the year, and you could have put plans in place for that. Okay. Alternatively, for charities, a lot of you will have a peppercorn rent, and a peppercorn rent is a rent. Some of you will know this. It's a rent that's levied, but isn't normally payable, and it's usually something like £1 a year. And it means really, it's in the contract to make it look like there's consideration in the contract, but you're never ever going to pay it. Okay. So using the same example as above, you think, yeah, that's a below market value rent. You may think you use the same principle and show the donated element as being £19,999 per year and credit that to the SOFA and have a massive donated good element, donated service element in the accounts in that 1 year. Thankfully, you don't. Okay. The charity SOAP says that this is a non-exchange transaction and the value of the donated element, effectively the £20,000 per year, will be shown as a gift in kind each year. So if you've got a peppercorn rent and it is clearly a peppercorn rent, then you don't have to do the lease calculation. There's no right of use asset on your balance sheet. There's no lease liability. You just continue every year to put through that donated element, which is different to, like I said, the below market rent value, where you've got to recognise that donated element for all years in year one. Okay. Just a quick question there. Is HP facility for a machine to be classed as a lease? In reality, HP already follows this treatment. You already put the asset on you would already put the machine as an asset on your balance sheet, and the HP liability would also go on your balance sheet as a liability. So, what these changes are doing is actually bringing all leases in line with what you would expect for a HP, effectively. Okay. So VAT is another area where errors can easily creep into the lease calculations, and it applies to all businesses that are impacted. The key principle is that the lease liability should reflect the cost that the business actually bears. So if you're VAT registered and you can reclaim the full amount of your VAT, the lease liability is calculated based on the net payments. If you're not VAT registered, then you would use the gross payments. If you're in the partial exemption business, non-business calculation, and VAT is only partly recoverable, only the irrecoverable element of the VAT should be included. So VAT continues to be dealt with through the VAT return process in the usual way. recognising a right of use asset doesn't change the normal VAT recovery rules. However, if you're using that partial exemption calculation, which a lot of charities do, and that's why it's in this section specifically. If your rent is £1,000 plus £200 VAT per month, and the business can recover 60% of the VAT, using the standard calculation, then £120 is recoverable of that VAT, and £80 represents a genuine cost to the organisation, because HMRC don't refund you that amount. So in that situation, the lease payment used in the calculation would be £1,080 a month. So it's the £1,000 net plus the £80 that you cannot recover due to your partial exemption calculation. So I hope that's given the charities and the VAT section has been useful. There is more examples in a charity webinar that we actually ran a couple of months ago, and you can find that on YouTube. But if you want the link to that, if you let us know, we can send that on to you as well. It goes into a few more details, a bit more, a couple of examples and things that might help flesh this out a little bit. But today's session is more about how you calculate it and the workings of it than going into real detail on the charities. Okay, so I will pass back over to Liam.
Thanks, Matt. So, yeah, now I'm going to move on to the right of use asset and the subsequent accounting of it. The right of use asset is the asset that's going to go on the balance sheet. It's going to go in with your fixed assets, that shows the business has the right to use this leased item. The calculation for the right to use asset, it normally starts with the lease liability we calculated earlier, with adjustments for things like payments made before the lease starts and any non-refundable upfront payments, such as deposits. On transition now, you need to be careful. We don't want to be double counting any amounts that have already been dealt with in previous years. So if you're on transition, if you're starting on the 1st of April, you don't want to be taking any payments that have been made prior to that. So after you've calculated your right to use asset, you put it on the balance sheet, then we've got to depreciate it over the lease term. We depreciate it over the lease term unless the ownership transfers at the end of the lease. So if there's a purchase option at the end and you've accounted for that and you think you know you're going to take the purchase option. So in that case, we'd use the useful life of the asset as being more appropriate. The lease payment is then allocated to the lease liability. It doesn't go to the P&L anymore. So either your purchase invoice or your cash payment, that needs to go against the lease liability. So obviously your bookkeeping is going to change. Payments may have gone to the rent expense, like I say before. The purchase invoice or the payment now needs to be coded to the corresponding lease liability nominal, which will then in turn unwind the lease liability. And the interest expense will then also need to be accounted for on the lease liability. So we'll have a journal set up where we'll debit the P&L for the interest expense and we'll credit the lease liability. And then over the period of that lease liability, it will unwind in a similar case that you would any loan or hire purchase agreement. What I would say is a sensible step is to set up separate nominal codes for each lease liability, so the balance can be reconciled properly. So you're allocating the payments for each specific lease liability to one nominal, and then it just makes it easier to reconcile. The profit and loss is going to look different. Instead of one rent charge, you will usually see depreciation and interest now. And Paul will discuss that more in the presentation to the account section. So I'll just move on to the next slide and I'll pass back to Paul.
Thanks, Liam. So yeah, presentation and impact on the accounts. And this is probably the slide that finance directors and business owners are most interested in. What's going to happen to my accounts if I bring in these right of use assets and these lease liabilities? How are my accounts going to look different? So bringing operating leases onto the balance sheet means that both assets and liabilities are likely to increase. The right of use asset sits within fixed assets, while the lease liability appears as a financial liability. Current liabilities will often increase because part of the lease liability becomes payable within the next 12 months. Okay. As a result, net current assets may reduce. However, you're likely to see your gross assets increase. And again, coming back to what I said for charities, that's important for audit thresholds and whether, excuse me, whether or not you meet that criteria. So even if you're a normal business, not a charity, there's a audit threshold for gross assets, and it may be that you actually breach that by bringing these on. So even if you're a business, not a charity, you might still need to think of that impact. Okay. You'll also see changes within the profit and loss account or the SOFA for charities. So like Liam just said, instead of a single rental expense, you're going to have depreciation of the right of use asset and interest on the lease liability. One consequence is that EBITDA, earnings before interest, tax, depreciation and amortization may increase because lease costs are no longer presented entirely as operating expenses. They're kind of shown below that line as depreciation and interest. Overall, you may see profits reduce in the early years and rise in later years of the lease due to the way the lease liability is unwound and higher interest being charged in the early years, to match real world scenarios of how interest is charged on loans. It's important that if you've got banking facilities, and you've got covenants to meet or gearing ratios to meet and things like that, you pay particular attention to this, because it may just be that bringing these onto the balance sheet change the calculations, and you may find you're going to have to explain that to your bank managers and the reasons why your gearing's changed or whatever, or you're not meeting the covenant ratios that you need to because of this. Management accounts, budgets and financial KPIs will need to change. That's our advice, to bring this in so you're getting a fuller picture of what to expect. And like I said, you may need to explain these to lenders, trustees, boards and other stakeholders out there. So while it's technically an accounting change, the commercial implications can be much wider. And like I've already said, it's the gross assets that could have a real impact and push you over the audit threshold. So I will pass you back over to Liam.
Thanks, Paul. So we're moving on now to transition to the new rules. So the new rules apply from the start of the first affected accounting period. So for a December year end, December 26 year end, that means from the 1st of January 2026, unless the business chose to adopt early. Under the practical approach, you do not restate prior years. Instead, any cumulative adjustment is recognised in the opening reserves at the date of initial application with the relevant disclosure in the accounts. Businesses will need to identify existing leases, remaining payments, lease terms, VAT treatment, discount rates, break clauses, and extension options. It's important that you need to go through, identify all this, and sometime you might assess some of your existing leases short term because of the remaining lease on them, but don't just take them as being short term. Assess them. I mean, for instance, I've looked at some where it's a rent for a property. The lease is essentially looking to end soon, so it needs to assess whether it's likely that they're going to extend. How far into talks are they? So don't just take it off the basis of the 6 months left on the lease term. How likely are you to extend that lease or continue to renegotiate the lease, essentially? So the main advice for the transition is start early. If it's left until the accounts are ready to be prepared, it's going to be harder and more stressful than it needs to be. So after that, I'm just going to move on now. So obviously to the next slide. What we've discussed so far is fine. Us telling you this is what we have to do, this is what you have to do. So what I wanted to do was I wanted to put a bit of a worked example in place to show you how we would calculate it, and how we'd work through a real life scenario. So I'm just going to share screen with you in a minute, and show you a lease calculator I've created. So I've used ChatGPT to make me a example lease. So this is our example of what we're going to try and account for. So it's a commercial rental for a property in the Greenway Business Park. So first thing we want to do is we want to look at the lease term. So the term of the lease is from the 1st of July 26 to the 30th of June 24. We also want to look at break clauses or extensions. I can see from here doesn't appear to be any extensions in here, but we do have a break clause of 10 years. So this is the calculator I've created, and I will be able to provide it to any of the clients who request it, who will want access to it. So this is our lease term calculator. So we've put the commencement date in here, which actually links to here. The lease end date goes in here, and the break clause date in here. We then put, are we expected to break, yes or no? So for this example, I've just put no, we're not expected to break. So this will calculate the payments based on that. No extension period, so we've got NA in there. This calculates a lot of this information. So next, we'll move on to the payment terms. So just because it's £185,000 per year, we don't want to take that as that's the figure we use, because what you can see is in the rent profile here, it's monthly in advance. So that's what we need to use. We need to account for it as monthly, because that's when the payments are coming out. Because if you remember, we're accounting for the present value of the payments, not the terms. So what I've done, we've got the monthly, we've classed it as monthly here as a drop down option. We've got the monthly amount, which is 185,000 divided by 12. And then 7.5%, there's no rationale behind that. I've just used 7.5% as an example. And the payment timing in advance, because this is important, because like I say, it can affect, especially this level of lease where you can see here the right to use asset currently stands at 1.7 million. The payment timing might change that quite a bit, because the first payment in advance doesn't necessarily get included in the present value calculation. So now we've accounted for all this. We've got the terms, we've got the amount, and then we need to put the upfront non-refundable deposit in, which goes in here, because that gets used to calculate on the right of use asset as well. So now we've done that, we've got our calculation for the lease liability. This shows us the brought forward amount, which is the lease liability, how many months is remaining in that year. Sorry, I should have said as well, the company year end I used as an example is April 2027. So we've got the interest calculated, the payment, which is all pulled down from all the information up here, and the carried forward. So this is essentially what you typically used to see from like a HP agreement. And what we would recommend is just using the monthly interest in terms of that divided by 12 or by 10 months, sorry, in that case. We wouldn't recommend unwinding the interest over the year if you're using this for management account purposes anyway. So yeah, and then the monthly depreciation is also calculated here. This is based on the asset being depreciated over the term of the lease. This doesn't take into account if you were to depreciate the asset over the useful life. So if just take a note for that. If you are, you do your own calculation for the useful life. Another point on this is we've got this to review and ongoing costs. So this here is what we discussed in terms of the index on the rent reviews. So yeah, it's noted that there's a 2% annual floor and a 5% annual cap equivalent, like a market rent review. But we're not going to account for that. We will account for that further down the line when and if it comes in. And similarly, what Paul discussed in terms of the service charges, it's got it here. So it's split out as part of the lease agreement as £18,000. So it wouldn't be eligible for the expedient of including it within the calculation, and it wouldn't necessarily benefit you. So that would be expense to the P&L. Yeah, so I think like I said, covered pretty much every off that. I've tried to make it as simple as possible that so anyone can just come in and use it. I have got a more detailed, not a detailed version, like it's more tabs along the bottom and a summary page that we can provide you with, so you can use multiple leases. But I'm gonna stop sharing now, and I will pass back over to Paul.
So yeah, practical action plans. So what should businesses be doing now? What should you be starting to do? It's likely you're in this financial year now. We're nearly at the end of June. So 6 months have passed after this has come in, for accounting periods starting on or after the first of January. So the first step is to prepare a complete list of all your existing leases. So that includes your property leases, vehicle leases, machinery, equipment, and any, like Liam's just said, any service contracts that may contain lease elements as well. So you need to gather the key information for each arrangement. So that's the start and end dates, the payment schedules, the extension options, any break clauses, any service and maintenance elements, and consider the VAT treatment, especially, if you're a charity that has partial exemption. So what you need to do is you need to then, once you've got those, review those contracts carefully, rather than relying on any assumptions or historical accounting treatments. You should also think about the wider impact on your management reporting, your KPIs and your banking covenants, like I mentioned, and it may be that if they're going to change significantly, your banking covenants, your gearing ratio and all that kind of stuff that you may need to report to the bank, you kind of go to your bank and preempt it rather than submit them some accounts and them say, whoa, what's gone on here? The earlier you start the exercise, the easier the transition will be. I know there's a lot of work involved, but if you don't leave it all to the year end, then you'll be under a lot less pressure, when it comes to working these out than you would be if you left it right to the end of the year. And like I said, if you leave it to the end of the year, it may be that, actually by doing this, you've realized you should actually be having an audit and that process could have started a lot sooner if you'd have done this sooner. Where you've got complex arrangements or they involve significant judgment or contain unusual terms, speak to us, your champion advisor early, and see what we think. A little preparation now can save a great deal of work later. Like Liam said, we've got a calculator, and it's a service that we've offered to clients, with advice tailored to each individual circumstance, copies of journals needed in the accounting systems and other accounting adjustments. And that's something, if you get everything out and, you've got loads of leases and you're overwhelmed by it and you think, oh my God, where do I start here? Please get in touch and we'd be happy to give you a proposal for what that might entail and how much it might cost. Okay. But yeah, if I can tell you anything, if there's one thing you take away from this webinar, it's start today. Don't leave it till the end of the year. Okay, so we'll move on to some questions and answers now. like I said, there's two or three questions in there. So I'll take the first one. If you take a lease for 2 to 3 years, and at the end of it you extend the lease for example, for forklift trucks, but you don't know if you'll extend or take a new asset out until the end of the lease. In that case, you would account for the right of use asset based on the 2 to 3 years, or however long the initial agreement is. At the point that you know you're going to extend, so if that's at the very end of the term, you would then reassess the lease then based on the new rental payments, or if they stay the same, or new borrowing discount rates and what have you that you could have at that time. Okay. Liam, are you okay to take up the next one?
Yeah, that's fine. So, if you have a 12-month lease that spans over a year end, does this fall in the rules of financial year would be under 12 months? So, I'm assuming you mean the extension, the short-term exemption here. So, if that is the case, if you've got a 12-month lease that spans over a year end, disregard the year end, assess the lease based on the lease term itself. So if it is a 12-month lease, then essentially it is potentially going to be deemed as short term. If that's not what you meant by that question, by all means, follow up in an email and I'll be able to elaborate a bit more on that one. Yeah, so the next one, Paul, do you want to have a quick?
Yeah, so with hosting and service and hidden lease elements, what you've described there, you've got IT support and hosting services for your server, but you own the server and it's on site there, and it's already in your assets. It doesn't sound like in that situation you are leasing that asset as well on top of your IT support and hosting. It's already there, it's already recognized. But it might be that there's something in there and specific to that lease that might be or whatever. But based on what you've said there, I would say there's probably no hidden lease elements in that. However, I'd recommend you get that looked at just to be doubly safe. And then the last one, I'm short term. If it's short term, it's less than 12 months. It's expense to the P&L straight away. It's expense to the P&L straight away. I don't know what you're getting at with the zero cost agreement. Unfortunately, if there's no cost to it, then there's nothing to put through the P&L really, unless you're a charity and it's a donated service, and then in which case it'll be a donated gift in kind, which would just increase your income and increase your expenses as well. Okay, so give it a minute just to see if there's any more questions come in. Yeah, so we'll just move it on and close the webinar down now. So thank you for attending today, taking the time to join us. It is a hot day, and we do appreciate that. And we've come in at an hour rather than an hour and a half. So I hope you appreciate that as well. Like I said, if there's one message to take away, it's that these changes are likely to affect more businesses than many people realise, and preparation is key. Start preparing today. The three things I'd encourage you to remember are: first, identify your leases early. Secondly, review the lease terms, the options and VAT treatment carefully. And third, don't leave the calculations until the accounts are being prepared. Like I've said a couple of times now, start today. You will receive the slides after the session, and we'd be grateful if you could complete the feedback survey when it arrives. If you'd like assistance reviewing your lease portfolio or understanding the impact on your accounts, please get in touch with one of us here at the Champion team, be that your own advisor or feel free to come to me or Liam direct. Thanks all for your time today.
Thank you.